All right, so welcome to topic 4 with annuities. So annuities, contrary to life insurance, annuities protect against the risk of living too long, right? So we know with life insurance, it protects against the risk of premature death, right? So individuals purchase life insurance, possibly to ensure that when they pass away, that their dependents will still be financially well off, right? With annuities, this protects the risk of living too long. So what does this mean? Well, maybe, someone might be planning for the retirement, right? So they might be afraid, oh, I might be living all the way to 100 and I might not have any funds, right? I might need to um, pay a lot for living, right? Maybe other care expenses. And so annuities, what it can do is it protects against that, right? By offering payments at a certain age, often during retirement season for individuals, right? So with annuities, there are two main periods. There's accumulation period and there's an annuity period. So accumulation period is the same thing as the pay-in period, right? So this is where the contract owner makes payments. So, um, right, this is where we put in money, and it can grow, and we'll take a look at that in just a moment. But it can grow, tax deferred. Okay. Annuity periods, on the other hand, right, is the payout period, right? So this is where the money that has been accumulated during that accumulation period, right, is paid out to the annuitant, right? So annuitant is another vocab term, and it's basically the person receiving, right, the payments. And it's also often paid out in something called annuity units, right? We're not going to go too much in depth for this introductory review course, but for sure, you're welcome to explore that more later on. So now let's take a look at specific types of annuity. So remember, we always want to tie everything to premiums, right? Because that's how it's funded. Just like life insurance, right? We need premiums to fund these policies. So a single premium is annuity funded by a lump sum payment, right? Just like a single pay or single premium life insurance policy. A level annuity is an annuity funded through regular payments over time, right? So maybe you're contributing $400 per month during the accumulation period. And the flexible is annuity funded by irregular payments, right? So policyholder can decide. So it's kind of like, universal life, where you kind of have that flexibility, right? But we can see that premiums can be paid in three different ways, right? Really similar to life insurance so far. Now, something that's different is that with annuities, we can select the timing of payments, right? So if individuals pay through a single premium, okay, they're eligible for immediate payment. So this is where payments begin almost a year after a lump sum. That's the condition. Lump sum premium is paid. Okay, so it's usually within a year. But with deferred annuities, this is where payments begin at a later time. And funds grow tax deferred, as I mentioned, right? So that's important. Funds grow tax deferred. And what that means, right, is that the funds grow, but they're not taxed until they're withdrawn. And so you can start paying out after many years after initial investments, right? So maybe during retirement, right? Retirement ages or other years set by the annuitant for retirement. We also have value options, right? So just like life insurance, we can see that during the annuity period or the payout period, right, there can be different ways that the payments are being made. But we're now thinking about the value, right? The value of the payments. So we can first have a fixed value annuity, right? So these are fixed annuities. Are these annuities that provide guaranteed fixed payments, right? So payments are fixed, they're guaranteed, maybe $800 per month, right, during the payout period. With variable, right, these are payments that are based on the performance of investments, right? So we can look at during the accumulation period. Let me go back here. Accumulation period, right? maybe those funds, right, grow, maybe not at a stable rate, right? They can grow at a variable rate. And so there is a lot of risk with this. What if we have a negative return, right? So that is a big issue with that. But this is where variable, right? Think about variable, right? Variable life, right? We can kind of relate that to variable annuities. And lastly, this is another popular type of annuity nowadays, right? This is an annuity where returns are based on the performance of a specific financial index, S&P 500. And so again, with this, right, there's that minimum, right? Minimum rate, right, of return of growth, or I can say growth. So, right, you wouldn't be losing, right, any of your funds, right, or premiums that were paid during the accumulation period. So, kind of relate this, tie this back to index universal life, right? And it's really, really similar in terms of the value options or how it's the funds grow. So now, right, besides from like talking about the value of the payout, we can talk about payout options, right? We can talk about how long the money is being paid out. So the first option is the straight line income payout option. So this is where it pays the annuitant a guaranteed income for the annuitant's lifetime, right? So just like the kind of the term says, there's that straight life income payout, right? When an annuitant dies, no further payments are made to anyone. Okay. So we're studying for the exam, when we're taking the exam, hopefully this will kind of remind you with what it means. We also have the life with period certain payout option, right? So this is where it's designed to pay the annuitant guaranteed payments for life for a specific period of time for the beneficiary. But the good thing is that it provides benefit payments, and these payments will continue for a minimum number of years, regardless of when the annuitant dies, right? So even after the annuitant dies, right, there can be payout. So we can often think about this with another similar term that you might see is the life income with period certain, right? It's the straight life income plus, right, benefit payments for a number of years, regardless of when the annuitant dies, right? Okay. All right, I have two more here. So another payment option is a lump sum payment. So again, right, it can be a lump sum payment immediately, maybe at the age of 90. There's that immediate payment, okay? And we also have the joint and survivor payout option. So this is where payments continue for a lifetime of two individuals. And payments continue right to the survivor after the one and two annuitant dies, right? So again, right, this is more of like a combination type plan or annuity plan as well. We can see how in any cases, right, we can have payments continuing for the lifetime of these two individuals, right? Even after one of those individuals or one of those annuitants have passed away. Okay, so here is a really good flow chart, really to kind of foment your understanding of annuities. So through this chart, we can tell and analyze the client's needs, right, with the appropriate options, right? And so this is really useful even for studying the exam, right? We're thinking about, oh, well, when we have, if they're risk aversive, we probably want fixed for index annuities, right? We don't want variable annuities, right? So kind of through that, you can also review your definitions of, oh, what does variable annuities mean, right? Those mean that the funds are not guaranteed, right? They can drop, right? Due to the market performance in the separate accounts. Okay, so this is interesting to take a look at, and I recommend doing this. It'll help with your review as well. All right, so now let's take a look at reviewing all of those topics 1 to 4 in this module, module 2, and this will help you to experience some real exam questions. Okay, so let's go through these questions now. So what the first one here, right? This is a contextual question, right? So besides from definition questions, your exam will also asks about these questions. So for number one, okay, the answer would be D. But why? Well, we know this is a factory worker who's concerned about inflation, right? So if they're concerned about inflation, um, then we know that you would probably want some sort of variable annuity. But before that, we can cross off two answer choices, which is A and B, right? Because the factory worker most likely can't pay a single premium, right? Okay. So that wouldn't be suit the client's needs. Another thing is that, right, because of the inflation that I mentioned, right, then we know that a level premium wouldn't fit, right? Because level premiums and fixed annuities, right, but especially with fixed annuities, the payout is guaranteed, but it's level, right? So for example, in the future, right, there's inflation, it might not be worth as much, and maybe variable annuities might better fit, right, or correlate with inflation, right? Because it can change, right? The performance of the market can change according to inflation rates, right? Number two, right? What is the interest sensitive form of permanent protection? Right, so that's universal life, right? We took a look at how, right, with universal life, we have properties in which you have interest rates, right? Interest rates have a guaranteed interest rate with universal life. And we also see that we have the term permanent protection, right? So it wouldn't be C. That tricked many students because they think about variable, right? Interest sensitive. But in this case, right, we're looking for permanent protection, right? So term life isn't permanent, right? So again, read through the questions. That is very, very important, right? Reading through the questions and looking through that is very important. Okay. Okay. So now let's go through questions 3 and 4, and then we'll go over them shortly. Okay. So let's look at number 3. So number 3, we're talking about which contract has its basic function as systematic localization of accumulated assets through periodic payments. So this is a what? A annuity, right? So this is more of a definition question, right? We have that liquid systematic localization or payout of assets. We're gonna look at number 4. Which of the following statements about a renewable term policy is correct? So with the renewable term policies, remember one of the key characteristics of term life is that it's renewable, right? And it's renewable at the option of the insured. And remember how it doesn't require proof of insurability, right? If we go back to our notes, our lecture material, right, we can see that um, it doesn't require undergoing a medical exam, right? Okay. So now let's look at questions 5 and 6, and we'll go over them shortly. Okay, so for question 5, an individual wishes to purchase whole life insurance but does not pay premiums past retirement age. So which one should the person buy? So again, this is a contextual question, right? And the answer choice would be D, right? Like if you're only paying maybe 50 years or 40 years and you're not paying right after that, then that would be limited pay life. Number 6. Okay, so we have Daniel and Karen are annuitants of a joint and survivor annuity. When either Daniel or Karen dies, right? Remember, the surviving annuitant will still receive payments for life, right? They'll still be able to receive payments for life. So we saw this was one of the payout options, right? So annuities are tricky because there's just so many types of annuities, right? You have payout options, right? You have premium options, you have value options. I know it's difficult, but again, we want to take some time to kind of organize this material according to, right, the characteristics so we can better understand and memorize them.